Did you know that short-term funds can often give higher returns than your savings account, with similar levels of risk? Surprising, isn't it? These funds, a type of debt fund, are designed to offer a blend of safety, liquidity, and yield. Unlike other debt funds, they invest in securities with a maturity of only 1 to 3 years, making them less susceptible to interest rate fluctuations. If you're looking for a way to make your money work harder for you, short-term funds could be an interesting avenue to explore. But what exactly are short-term funds, and how do they work? Let's unpack this. Short-term funds, as the name suggests, are investments that mature within a short time frame, typically 1 to 3 years. The main objective here is safety and liquidity. Now, onto portfolio composition. A short-term fund portfolio is a mix of corporate bonds, treasury bills, and money market instruments, among others. Consider it like a fruit salad, where each fruit represents a different asset. For example, the apple could be a corporate bond offering a taste of stability, the orange might be a treasury bill providing a zest of security, and the pineapple could be a money market instrument adding a twist of high liquidity. The proportion of each fruit, or in our case, asset, would vary based on the fund manager's strategy and market conditions. Understanding the structure of short-term funds is key to making informed investment decisions. Every investment comes with its own set of risks and potential returns. So what can you expect from short-term funds? Well, the risk in short-term funds is generally lower compared to long-term investments. This is because the impact of interest rate fluctuations is less pronounced over shorter periods. However, keep in mind that lower risk also means lower potential returns. In terms of income generation, short-term funds employ accrual strategies. This means they earn interest over the holding period, rather than relying on price appreciation. And here's the beauty of it. The interest accrues every day, compounding over time to give your investment a nice little boost. But remember, the devil is in the details. It's crucial to understand the nature of the underlying assets in your short-term fund. This will help you gauge the risk and return dynamics more accurately. With short-term funds, you can often achieve a balance of risk and return that suits your investment goals. Before you jump into investing, it's important to understand the tax implications and regulatory aspects of short-term funds. These funds are subject to income tax on their earnings, which can be at your ordinary income tax rate. However, if held for more than 3 years, they can benefit from long-term capital gains tax, which can be significantly lower. Regulations for short-term funds are stringent, providing an extra layer of safety. The Securities and Exchange Board mandates these funds to invest primarily in securities, with a maturity period of 1 to 3 years, limiting the risk of market volatility. When it comes to investment strategies, diversity is key. Spreading your investments across various sectors and credit ratings can help mitigate risk. Additionally, aligning your fund choices with your financial goals and risk tolerance can lead to more successful outcomes. Armed with this knowledge, you can navigate the world of short-term funds with confidence. So how do short-term funds stack up against other debt fund categories? Well, short-term funds generally offer lower risk and modest returns compared to long-term debt funds. However, they are more liquid, making them a suitable choice for investors seeking short-term financial goals. On the other hand, income funds and dynamic bond funds might offer higher returns, but come with higher risk. In the end, the best investment for you depends on your individual circumstances and investment goals.